Welcome. I'm Catherine Magana here with Vince Stefano, Greg Carroll, and Rachel Ivanovich, where we're here to provide you some insights about the market, tax planning, and today we're going to talk a little bit about some tax planning ideas with Roth conversions and things that we've been hearing. But before we start there, I just want to give you an update from where we're at from the markets from last week to this week. We haven't seen too much movement. However, I'm a little surprised because there's a lot of tension right now between Israel and Iran and the Middle East, and so I was expecting the market to move a little bit more, but it hasn't. We're pretty much flat from where we were from last week, up a little bit today, or year to date today from where we were last week. But once again, not too much movement with the markets this last week, as we just kind of finished up third quarter and now wrapping into fourth quarter. And September ended up being a really good month. I mean, it was a little bit better than we probably expected.
Yeah, fourth quarter brings kind of leading into what Rachel's going to be talking about with tax planning stuff. It is time to start looking at maybe tax loss harvesting. If you're making IRA contributions and you haven't done it yet, there's a lot of different things you want to kind of do a little checkup in the fourth quarter. Make sure you're prepared before December 31st.
Check your withholding.
Mm-hmm.
Make sure you paid your estimates. It's
Talking
important.
And speaking of the end of third quarter, we're now into the reporting season for stocks, third quarter reporting season, and this is the quiet period. So you're not hearing much right now. Unless there are pre-announcements to the downside, you're not seeing much from stocks. And so, and also, a lot of companies over the past 6 months have announced that they're going to do significant amounts of buybacks. And also during this quiet period, there are no buybacks. So the market right now is kind of in a dogfight. Catherine had mentioned Israel and what's going on in the Middle East. Well, there's a dogfight going on between what's going to happen. Are we actually going into a period of slower growth? And are we going to avoid a recession, or are we going to actually, start seeing a very mild one? I don't think we're going to see a mild recession. I think the Fed maybe has it correct this time. We may see a soft landing. And there's also a dogfight going on between growth stocks and value stocks, and companies that have underperformed really for the last year and a half are now starting to percolate a little bit. So possibly you're seeing a broadening of the S&P, broadening of the Dow, broadening of the Russell, mid-cap as much as the small-cap index is concerned as well. I'm a growth stock manager. I love growth stocks, but I'm not going to poo-poo value stocks. There is something there. Again, I just don't focus on those stocks as readily as I do more growth stocks. With that being said, innovation is in the technology space. Innovation, believe it or not, is in retail space, because there is a significant amount that happens within the retail space that can allow companies to move forward and show a significant amount of growth. So I still think that you have to invest in those companies that have the innovation, companies that have a lot of upside potential from a large addressable market. And that's typically, in growth stocks. And as a friend of mine once said, there are no bears on Park Avenue, so be awfully careful.
It's good. So kind of circling back to the beginning, what I shared, we're going to talk a little bit about some tax planning, and I know Greg touched on it too, about planning. So we've been having a lot of conversations about Roth IRA conversions. There's a lot of articles, information. It's not a one-size-fits-all. It does not make sense for everybody. You really have to look at it case by case and look to see, does this make sense for me? And one of the things that we look at is, what kind of income do you have coming in? Is there rental, Social Security, pension? What kind of dividends and interest? And looking at everything that you have, and then potentially it may make sense if you're not taking required minimum distributions. There might be some gap years where you may not have as much income, and it may make sense for you to do a partial Roth conversion. But then what we look at is, okay, how much could you do without jumping up a tax bracket? And then also, what do we think you might be later for RMDs? What tax bracket do we think you'll be in the future? So there's a little bit of review, tax planning. Obviously Rachel's here to help, but also
Well, I have 13 more days of tax season.
Yeah.
So.
I eyeballed you.
But what I'm seeing a lot is, people who have refunds, they're like, well, can I just apply my refund to 2024 and I want to do Roth conversion, and then I'll have the money already, in the coffer to cover
the taxes.
And so looking, like Catherine, like you said, making sure, what does my income look like in 2024? And do I have some wiggle room in my tax bracket? So maybe if you're in the 22% bracket, do I have $50,000 worth of room where I can convert $50,000 of my IRA and pay tax on that $50,000 at the 22% rate versus jumping up to the 24% bracket? And rates are going to be going up in the future. I mean, maybe under the Tax Cuts and Jobs Act in 2017, the tax rates came down, and they're set to go back to those higher rates as of end of 25. So I think it's a really great time. Consider Roth conversion.
And then once again, it's not for everybody, but it does make sense in certain circumstances.
Well, another great thing about doing the conversion is it will reduce your overall balance in your traditional IRAs, meaning you have to take out less when you get to the age where you have to begin taking money out of your traditional IRA. And Roth IRAs do not have required minimum distribution rules unless you inherit a Roth IRA, and that's a whole other podcast.
Yeah. And then just a couple little details with the Roth conversion is once you fund it, then that starts the 5-year clock. So then
Correct.
You have to have that account or that money in that account for 5 years to really benefit. If you need to take money out, then it comes out tax-free after 5 years and over 59 and a half and all the other rules that go along with it. But so there's a little more to it, but just want to make sure that if you're interested in having us look at that, please let us know. We're happy to do that analysis for you.
Definitely calculate the taxes you owe, because you do owe taxes when you do that conversion, so keep that in mind.
I've done a couple of 401k meetings for some of my clients, and what's interesting with tax rates potentially going back up is a lot of 401k plans offer a Roth option, and a lot of companies match a certain amount of your contributions. And those contributions from the company are always going to be pre-tax. So I'm talking to a lot more of the participants about putting money into the Roth side, so you don't build up necessarily that huge tax deferred account and get into a position where you're taking minimum distributions down the road that might be larger than you want to be. So it is a good way to diversify even in your 401k plans at work. So another planning opportunity for
Actually, that brings up a great subject, because starting in 2025, if you're over 60, so individuals 60 through 63 years old can make catch-up contributions of $10,000 annually versus the $7,500 that you could previously. And then starting in 26, if you earn more than $145,000 in a prior calendar year, all catch-up contributions to your workplace plan at age 50 or older will need to be made to a Roth account in after-tax dollars. So you won't have that buildup in certain circumstances. So I thought that was really interesting. Yeah,
that's next
2026?
2026, yeah.
2026.
And so they use it only if they're over age 50?
It's
like,
random.
how are they
I
gonna-
know. Who makes these rules up?
Right?
No, this is under the Secure 2.0 Act. I don't know. I didn't make it up. I'm just the messenger. But it does say after 2026, if you earn more than 145 in the prior calendar year, all catch-up contributions to a workplace plan age 50 or older will need to be made to a Roth account in after-tax dollars. Okay, that's an interesting new rule.
So with the Secure Act of 2.0, another item that's come up over the last few years is for those that have gotten an inheritance or inherited IRA after the Secure 2.0 Act came out, that they have 10 years to take money out of the IRAs now. And then there was the question of, well, do they have to take requirement of distributions? And then for the last several years, they haven't. And it looks like, based from what we can tell, for 2024, you still don't need to. But that's the guidance we've seen recently.
That's the current guidance.
Yes, they could change. But as of right now, but starting in 2025.
So this is for non-spouse beneficiaries.
Correct. So then starting 25, even though you had that 10 years, you will need to start taking requirement of distributions starting in 2025. So there's a lot of rules, a lot of changes, definitely something we're keeping our eye on.
And you can't stretch it out over your lifetime like you used to. You have to actually deplete the account within 10 years.
Well, I guess the other question
call
of all
us.
this is not only are these tax cuts to expire in 2025, and the market's been kind of looking at that a little bit because we have had significant volatility since the Fed cut rates by 50 basis points. I think a big question mark is, what's going to happen with the presidential election coming up, because, it's hair thin right now. I mean, you look at the polls and, it can go either way. Flip a coin.
Flip a coin.
And, depending how the election does go, could have a big effect on taxes, both business and personal, depending on which, which side gets in. So, I think the market's struggling with that right now because, it can't figure out, who might be the winner, come November 5th. But, again, this isn't I'm not making any political statements, but, its market is looking at a lot of tax and economic policies. So there you go. And you're going to see choppiness right through November.
Great. Well, with that, I think that's a wrap for today's series. So thanks for joining us, and we'll talk to you next week.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.